So okay, 5.1, right? General. So general is the same as general entries, né? So you have debit, you have credit. Can you guys see? Okay, please let me know if you can see. Let me know if you can see. Let me know if I need to move my camera or something. Let me know. So okay, the first one, it says depreciation of 30% per annum on the diminishing balance method must be provided on equipment for the current financial period. Equipment was purchased on 1st November 2018 worth 30,000 exclusive of VAT. So okay, one thing you need to know about accounting is that we like to use synonyms. So sometimes for diminishing balance we can say carrying value. Sometimes we can say book value. So you need to know that when they say diminishing, is the same as book value, is the same as carrying value. Why is it the same as carrying value? What is the formula for carrying value? It's cost less accumulated depreciation, right? So remember, with accounting, synonyms are very key. So they say the first one, so it's depreciation. So I always tell people that before you calculate anything, before you make mistakes on the calculator, please do the journal, do the principle. I know that with depreciation, I have to debit my depreciation account. And then which statement does depreciation goes to? Statement of profit or loss, right? Are we fine? Yes. So remember, statement of profit or loss, you take your income and your expenses, right? And then, okay, what is the contra account for depreciation? It's accumulated depreciation. Accumulated depreciation, right? And then you with accumulated depreciation, you need to be specific on which accumulated depreciation are you dealing with. So for this one, it's for equipment. And then you ask yourself, which statement is a statement of profit or loss or statement of financial position? So accumulated depreciation is a negative asset. And then we know that on a statement of profit or loss, on statement of financial position, we record our assets, equity, and liability, right? So since it's a negative asset, you're going to take it to a statement of financial position. So far, you have the marks before calculating anything, before making the mistake on the calculator, before making any mistake. Already, by knowing the principle, you know what you're doing here. So by this, you already have half a mark. You already have 1 mark, right? So now we go to the calculations. So I always tell people that with calculation, please make sure, especially when you bought an asset during the financial period, so start with that asset that you bought. So remember, it says equipment was purchased on 1st November worth 30,000 exclusive of VAT, right? So with equipment that was purchased, you calculate depreciation from the day it was bought until the end of the financial period. Let me repeat that. With equipment that was purchased, you calculate depreciation from the day it was bought until the end of the financial period, right? So what is the day that we bought? We bought it when? 1st November 2018. When is the end of the financial period? 31st December 2018, right? And then, okay, from 1st November 2018 to 31st December 2018, it's how many months? November, December. So we get 2 months. Are we fine? So always, equipment that we purchased, you calculate depreciation from the day we bought that equipment until the end of the financial period. So what is the cost? The cost is 30,000. Remember, exclusive of VAT, right? So 30,000. And then they say diminishing balance method. Okay, so what is the formula for that? It's cost less accumulated depreciation. So this asset, this is our current period, right? So this asset doesn't have the accumulated depreciation because it was bought during the current financial period. But now, to show that you know what you're doing, you say minus 0. So this 0 is your accumulated depreciation for this current period, right? So I know that 30,000 minus 0 is 30,000. But remember, they said diminishing balance method, cost less accumulated. Please show that the 0, even if the equipment doesn't have accumulated depreciation as yet, right? And then they said it's what? 30%. Multiply by 30%, right? And then multiply by months. So remember, with months, it's from the day it was bought until the end of the financial period. And then how much do you get? So, okay, 30,000 multiplied by 30 times 2 over 12. Then you get 1.5, right? So this 1.5 is your depreciation for the new equipment that was purchased on 1st November 2018. And now you calculate depreciation on the remaining equipments, which were there from the beginning until the end of the financial period. So now with this one, look at the cost. So the cost is 30,000, and then it was bought during the financial period. And then I'm given a trial balance as at 31st December 2018. So it means the equipment that we have. So we have equipment of 553,453, and then we need to remove the equipment that was purchased during the year, so that we can get the total cost of equipment before we add the one that was purchased during the year. So with this transaction, you must be careful. If we say to you, equipment was bought on 1st November 2018, but now this equipment was not recorded. So if we told you that we bought it on 1st November 2018, but it was not recorded, so it means this 30,000, it's not here. But if the question is silent, so now the 30,000, it's here. So we need to remove the 30,000 to get the remaining equipment, right? And then what is the formula? Cost less accumulated depreciation. And then you look at the accumulated depreciation, it's how much? 42,342. Can you guys see? I hope you can see, and I hope I'm audible enough. Please let me know if I need to shift my camera. Let me know if I need to write bigger. Let me know if I need to increase my voice. So okay, cost less accumulated depreciation, right? And then what is the percentage? 30. How many months? 12 over 12. Because these equipments were there from the beginning until the end. I know that 12 over 12 is 1, and anything multiplied by 1, you get that answer. But remember, with accounting, we're talking about principle. Do you know what you're doing? So even though it's 1, please write it. It's necessary to write 12 over 12. Because now when the auditor comes, they will see that, okay, this equipment was there for the whole year, right? Okay, and then what is the answer to that? Let's see. So 553,453 minus the equipment that was purchased during the year. And then you minus 42, which is the accumulated depreciation. Then multiply by 30%, which is the rate that is given. You get 1. So you get 144,333. I'm just going to round it off to the nearest whole, right? Okay. So now you have 2 depreciation. So you have for the equipment that was purchased during the financial period, and for the remaining equipments, right? And then when you add these two, so you have 1,500 plus 144,3330. You get 1. Okay, let me use a different color. Let me know if you can see this blue. 145833. So you debit your depreciation with 145833. You credit your negative asset, which is accumulated depreciation for equipment. 145. Yes. So far so good. So far so good. So remember, where there's a debit, there must be a corresponding credit. Those who know me, where there's advantage, there must be disadvantage. Yes. Where there's good, there's evil. Where there's God, there's Satan. Yes. So okay, I'm gonna do so I'm gonna help you guys with okay, so the blue. Okay, I'll change this color. So let me just use black. I'll stick to black. Fine. Okay, is it fine? 1 4 5 8 3 3. So remember, you must also have a calculator. When I press, you must also press, right? A financial accounting student is a student with a calculator. So okay, just for in case, if they could ask the ledger account for accumulated depreciation. So let me just do the ledger account for accumulated depreciation. So please take a screenshot of what's here. Like keep it in mind. Keep in mind. Okay. So I'm gonna do the T account for accumulated depreciation. Nah? Okay, so remember, accumulated depreciation, debit, accumulated depreciation for equipment. So remember, this is a negative asset. Where does your asset increase? Initially, asset increases on the debit side, they decrease on the credit side. So now if this one is a negative asset, it means now it's going to increase on the debit, and then it's going to decrease on the, it's going to increase on the credit and decrease on the debit, right? Okay, so now where the account is increasing, the balance is going to be on that side. Nah? So okay, what is the balance for this equipment? So the balance, check your trial balance. So we have a balance of 42,342. And then what can increase my accumulated depreciation for equipment? It's when we have depreciation. Remember, the word accumulate is to add, right? So it means basically it's the total depreciation added together. You get accumulated depreciation. So now you need to add the current depreciation. So remember, the depreciation we just calculated as 1,4,5,8,3,3, right? Are we fine? Yes. So now you balance your ledger. I know it's very easy. It's very easy because we don't have disposal. We don't have a part where we are selling the asset. So it's very nice and clear. So now when you add these two, okay, let me add my credit. So it's 42,342 plus 145,833. You get 188,175. Right? You write it on both sides. And what is this? This will be your balance. So this will be your balance carried down. 188,175. Are we fine? Can you guys see? Can you see? Are we fine? Are we fine? So far, so good. Okay. So that's it for depreciation. So remember, you must know the journal. Before you do the calculation, know that you must debit depreciation, you must create accumulated depreciation, right? And then you start with the asset that was bought, and then you calculate for the remaining, right? Can I do number 2? So number 2, what's happening? So number 2, rent income was received to the value of 40,000. So the premises was let from 1st August 2018 for 5,000 per month, exclusive of VAT. Yes, so the amount should be exclusive of VAT. The amount should be exclusive of VAT. So now the rent per month, it's 5,000, right? But now we received the rent to the value of 40,000. So now, okay, let me show you something. So 1st August, yeah? So 1st August 2018 to 31st December 2018, which is the end. Remember the matching principle. We want all expenses and income that occurred during the financial period to be recorded, right? So, okay, 1st August 2018 to 31st December 2018. It's how many months? So we have August, September, October, November, December. It's 5 months, right? So it means on the statement of profit or loss, we should show our rent income for 5 months. But now let's do the calculation. What is the rent for 5 months? So you're going to say 5 months multiplied by 5,000 because we are given the rent per month, right? And then, okay, I know some of you will say, Francis, 5 times, it's very easy, it's 25. Okay, I don't know what's happening to my corky pen. Okay, so far so good. 5 multiplied by 5,000, you get 25. So now this 25,000, it is the amount that should be shown on the statement of profit or loss, right? But now we received rent income for 40,000. So we received rent income for 40,000, right? Okay, so now you ask yourself, okay, if I receive my rent for 40,000, but for this financial period is only 25,000. So the rent after that, we call it what? Income received in advance, right? So we received that income in advance because we only wanted income for this current period, which is the ending of it, 31st December 2018. But now they decided to pay us in advance. So now we need to calculate how much did we get paid in advance. So you say 40,000 minus 25,000. You will get 15,000. Okay, remember there are many ways to calculate something. One could say 40,000. So let me say or. So one could say 40,000 multiply 40,000 divided by 5,000. When you divide by 5,000, you're gonna get the months that this 40,000 is for. So it's for 8 months, right? So if it's for 8 months, I only want for 5 months to be shown on my statement of profit or loss. You minus 5 months, you are left with 3 months. So this 3 months multiplied by rent per month, and then it takes you to 15,000. As I say, there are many ways to calculate something. So far so good. So if you are fine with the calculation, and then now we need to show our journal now. So this journal, it won't change. When you have income received in advance. So what do? You need to decrease your rent income because our rent income, it was 40,000. But now on our statement of financial position, we need to record rent for 5 months. So we need to decrease our rent income with 3 months because that 3 months is the one that was paid in advance. Are we fine? So you're going to debit your rent income. You're going to credit your income received in advance. Okay, which statement does your rent income goes to? Statement of profit or loss. And then income received in advance, remember, it's a liability. Okay, why is it a liability? Because we received the income. It's a liability because if at the end of the financial period, 31st December 2018, this person decides to leave the premises. So now we need to pay back that person the 3 months that we received in advance. So basically this money, it's not ours until those months, until we reach those months. So that's why it's a liability, right? Yes. So liability goes to statement of financial position. Okay, and then you ask yourself, from the calculation, which is I have 25,000, that must be shown on my statement of profit or loss. And then the 15,000 is the one that was received in advance. So it means I need to decrease my income, my rent income, with 15,000 to get 25,000. Are we fine? Yes. So it means on the debit side, I'm going to have 15,000. And then where there's a debit, there must be a corresponding credit. So it's 15,000, 15,000. Are we fine? So far so good. So far so good. Can I move to number 3? So far so good, ne? Okay, 3. Okay, you see this one. This one, most people are struggling with it. Allowance for doubtful debt. Okay, remember I said with accounting we like synonyms. So doubtful debts, credit losses are the same thing, right? Are the same thing. Bad debts are the same thing. It's just different terminology that we use. So if you are used to allowances for credit losses, know that allowances for doubtful debt is the same thing, and then allowance for bad debt is the same thing. So now they're saying to you, allowance for doubtful debt must be adjusted to 30,000, right? So they must be adjusted to 30,000. So most of you are used to be given a percentage that allowances. So most of you are used to getting that allowances for doubtful debt. It's 5% of the trade debtors or trade receivable, right? So now with this one, they told us that we need to adjust it to 30,000. And then now you go to your trial balance. You look at your allowance for doubtful debts or allowances for bad debts. So now on your trial balance, it's 50,000, right? So this is the provision that we made at the beginning of the year that the allowance will be 50,000. But now we are told that we should adjust it to 30,000. So okay, let me ask you, are we gonna decrease or increase our allowances for bad debts? So we have 50, and then now they are telling us we should be on 30. So now we need to decrease our allowance, right? With what? With 20,000, because 50 minus 30 is 20. Okay, let me do the calculation. So at the beginning we budgeted 50,000, right? And then now on the adjustment, we are told that the allowance should be adjusted to 30,000. So it means the adjusting figure is 20,000. Are we following? Yes. So now, what's happening to my allowances for doubtful debt? It's decreasing. Now, so you ask yourself, so since my allowances for doubtful debt, it's a negative asset, right? Because it's decreasing your trade receivable. So it's a negative asset. And then now, my assets are increasing on the debit side, and then they decrease on the credit side. And then now my negative asset are increasing on the credit side, and then they are decreasing on the debit side. Okay, I think I need to write that down. So you have assets, right? So your assets are increasing on the debit side, and then they are decreasing on the credit side, right? And then you have what we call a negative asset. Right? A negative asset will increase on the credit side and then decrease on the debit side. Right? Okay, so debit decrease. So what's happening? So now it means my provision for doubtful debt should be debited for us to decrease it with 20,000. So now I've given you the journal. So what is the journal when you have a decrease for doubtful debt? You want to debit allowance. So remember, bad debts, doubtful debts, credit losses are the same thing, right? And then you're going to credit your bad debts or credit losses, right? Okay, let me okay, my cameraman have to go to the loo. So okay, I'll try to hold this and write at the same time, but so far we're fine. So you debit allowance for bad debts, and then you credit bad debts or credit losses, right? And then now, which statement does your allowance for bad debts goes to? So remember, it's a negative asset. So asset goes to statement of financial position. Are we fine? And then bad debts or credit losses, it's an expense. And then expenses goes to statement of profit or loss, right? And then you ask yourself, what is the amount? So remember, we need to decrease our allowance for bad debts with 20,000, right? So now we have to decrease. Where do you decrease a negative asset? A negative asset is decreases on the debit side. So it means I'm going to write 20,000 here. and then 20,000 here, right? So now, if they've given you a percentage, and then they said allowances for bad debts must be adjusted to 5% of the trade receivable, right? So you're gonna take the trade receivable, right? And then you subtract any bad debts or credit losses that we have on the adjustments, and then you multiply by 5%. When you've done that amount that you get, you're gonna compare it with the one on the trial balance, right? And then you check whether is my allowance gonna decrease or increase. So if it's decreasing, you're gonna debit your allowances for bad debts, and then you credit for bad debts or credit losses. But if the one on the adjustment, it's more than the one on the trial balance. Nah. So listen to me. If the one on the adjustment, it's more than the one on the trial balance, right? So it means you need to increase your allowances for bad debts. And then allowances for my bad debt, it's a negative asset. Where does your negative asset increase? On the credit side. So it means now you're going to credit allowances for bad debts, and then you're going to debit bad debts with the difference. Are we following? Yes. So okay, let me repeat this one, because I know most of people are struggling with it. So first thing, okay, let me put it, easy. First thing, compare the allowance that you have on the trial balance and the allowance that you have on the adjustment. So if the allowance on the adjustment, so let me write here, if the one on the adjustment, it's greater than the one on the trial balance, so it means you need to increase. So it means you need to increase your allowance for credit losses. Where does you increase your allowances for credit losses? The fact that it's a negative asset, you're going to increase it on the credit side. So it means you're going to debit, let me give you the journal, you're going to debit credit losses or bad debts, and then you're going to credit allowance. Right? Are we fine? So this is when the allowance for doubtful debt on the adjustment is greater than the one on the trial balance. It shows that you need to increase with the difference, right? And then vice versa. If the one on the adjustment is less than the one on the trial balance now, so it means you need to decrease with the difference. And then now you're going to do what? You're going to debit your asset, your allowances, and then you're going to credit bad debts. Are we fine? Okay. So those who have questions, Sipo will be answering your questions while I'm presenting. Just be specific on where you didn't get me, and then he will respond to you. So okay, can I move to the fourth one? Let me go to the fourth one. So okay, the fourth one says stationery worth 5,000 exclusive of VAT, was used during the year. So now, when we bought stationery, it was consumable stores, right? When we use that stationery, now we transfer it from consumable stores to the expense account. So we want what is used on the statement of financial position. Okay, let me write it down. So what is used will go to your statement of profit or loss, right? But what is on hand will go to your statement of financial position. Are we fine? So on the statement of profit or loss, we want what is used, and then what is on hand will go to your statement of financial position as consumable stores. Right? So now, what is the journal? So the journal is that we need to recognize stationery. When you recognize stationery, what do? You debit stationery because it's an expense, and then your expenses go to your statement of profit or loss, and then you credit your stationery on hand. Stationery on hand. Statement of financial position. Remember, stationery on hand, it's consumable stores, and consumable stores are your assets. Are you guys fine? Are you guys fine? Okay. So now, the amount. So the amount is given. So the amount, it says stationery worth 5,000 was used during the year. So we want what is used on the statement of financial position, right? And then what is used will decrease your consumable stores. So now we need to decrease our consumable stores. Remember, consumable stores is an asset. And then now your asset decreases on which side? On the credit side. So we need to decrease our consumable stores with what is used. And then you have debit 5,000, you have credit 5,000. Are we fine? So far, so good. So far, so good. Are we fine, guys? Please let me know. Are we fine? So if you master adjustments, I think going forward with doing the statement of profit or loss and statement of financial position, it's a matter of knowing your skeleton and knowing what you're supposed to include and exclude. So okay, remember, if you have a question, please state it on the comments, and then Sipo will respond to the questions. So okay, let me do statement of financial position. So 5.2 says prepare the statement of profit or loss income statement after adjustments, right? So okay, 5.2 statement of profit or loss. So it's a matter of knowing your skeleton. It's a matter of knowing what you should include and what you should exclude. So what is the first item on the statement of profit or loss? You have sales. So these ones are just principal mark because it's given, it's just there. On your trial balance, what is your sale? Your sale will be on the credit side because it's an income. 2549392, right? And then now sales, you less your cost of sales. So less cost of sales. What is your cost of sales? Your cost of sales should be on the debit side of your trial balance because it's an expense, right? So subtract your cost of sales, which is 1,678,357. I'll be fine. When you take your sales, you less cost of sales, you get what you call a gross profit. Right? Okay. Then let me press my calculator. So you have 2,549,392 minus 1,678,357. And then I get 871035. So that's a gross profit, right? And then from here, skeleton, you add your income, right? So your income will be on the credit side of a trial balance, right? So which income do we have on the trial balance? We have rent income. And then you ask yourself, do I have any adjustment that affected my rent income? Yes. Which is adjustment number 2. So adjustment number 2, we had to decrease our rent income with how much? With 15,000, because the 15,000 was income received in advance, and we want what is used during the financial period, right? So with the value of 40,000 that we received, we need to remove the income received in advance. And then remember, I told you that 25,000 should be the one recorded on the statement of profit or loss, because we want what affected our current financial period, right? Matching principle. And then now you less your what? You less your expenses, right? So what is the expense that we have? We have rent expense. Okay, So all your expenses are gonna be on the debit side of the trial balance, right? So you have rent. How much is your rent expense? 4,230,96. Are we fine? And then what is another expense that you see? Advertising and promotion, right? Advertising and promotion. You ask yourself, was there any adjustment affecting advertising and promotions? No. And then you just write it the way it is, right? And then we have what? Electricity and water, right? Was there any adjustment affecting water and electricity? No. And then you just write it the way it is. 3, 4, 2, 3, 4. Do you see how simple it is? This is just principal mark. This is just principal mark. 3 marks. And then we have what? Bad debts, right? So bad debts. Do you have any adjustment affecting bad debts? Yes. That's adjustment number 3. So on adjustment number 3, we decreased our doubtful debts by doing what? By debiting doubtful debts and then crediting bad debts. So when you credit an expense, is it an increase or a decrease? So remember, your expenses increases on which side? On the debit side, and then they decrease on the credit side. Right? So what is your amount on the trial balance? So the amount of the trial balance is 98,657 and then minus 20,000. Because the 20,000 was on the debit side, right? It was on the credit side of our bad debts. So now you say 98,657 minus 20,000. You get how much? You get 78,657. Are we following? So why is it a minus? Because it was credited when we're doing adjustment number 3. And then which expense do we have? Again, we have salaries and wages. Do you have any adjustment affecting that? No. So we just record it the way it is, right? Which is 150,675, right? And then you have telephone. Do you have any adjustment affecting telephone? No. So we just write it the way it is. 45,336, right? And then you have another expense. Do you have any expenses on the trial balance? Okay, telephone was the last one. When you're done with all the expenses on the trial balance, you go to adjustments and then you look at any expenses that we have omitted or that was not on the trial balance that should be included. The first one is what? Depreciation. So remember, we've calculated depreciation on adjustment number 1. And then we got, it's an expense, so it's minus 1,458,33, right? And then do we have any other expenses? Yes, adjustment number 4, which is stationery. Right? So which is stationery. So stationery, we said we want what is used, right? On the statement of profit or loss, we want what is used, right? And then they told us that we used a stationery worth 5,000. Do you have any other expenses? No, right? And then now you calculate. So you start from gross profit. So your gross profit, it's 871,035. You add your income, which is 25,000, and then minus 423,096 minus 6,353 minus 34234 minus 78,657 minus 150,675 minus 45,336 minus 145,833 minus 5,000, and then you get how much? It's a positive amount, 6 851. So the fact that it's positive, it's what? It's profit. So you write profit for the year. So when you get here, guys, it's not, you're not gonna say profit or loss for the year. No. Here we decide whether it's a profit or it's a loss. So if the amount is positive, it's profit. If it's a negative, it's a loss. So don't say profit or loss for the year, because now you know whether it's a plus or a minus, right? And then we know that this profit will affect our equity, right? When we do the statement of financial position. So far, are you fine with statement of profit or loss? So with statement of profit or loss, there are things that you need to watch out. Depreciation, most of the time it's not on your trial balance, but it's on your adjustments. And then you need to check if there's any expenses that is not on the trial balance, but it's on the adjustment. And then you need to include that expense, right? So, okay. Lastly, so I believe that the difficult part is only the adjustments. And then after this, you just have to plot. You need to know where to put what. So lastly, it's what? Statement of financial position, right? So quick one, 5 minutes, and then we are done. 5 minutes. Statement of, so it's 5.3. Statement of financial position. Okay, so what is the first item? Assets. And then under assets we have what we call a non-current asset, which are your long-term. So it means they are used more than 1 year. Non-current asset. And then you go to your trial balance. You check which non-current asset do I have on my trial balance. The first one I see we have land and building. And then you ask yourself, was there any adjustment affecting my land and building? No. So you write it the way it is. 3, 4, 3, 2, 4, 2. Right? And then secondly, you ask yourself, which non-current asset do I have? So remember, these are your assets that you use more than 1 year. I have what we call equipment. So my asset should be at carrying value on the statement of financial position. So how do you get a carrying value? To get a carrying value, you say cost less accumulated depreciation, right? So what is your cost? So your cost is 553, right? Minus accumulated depreciation. So I have accumulated depreciation at the beginning, which is 42. So I'm going to add the 42,000, the one at the beginning, 42342, and then I'm going to add with the current depreciation, and then they give me a total accumulated depreciation at the end, right? So 188,175, right? And then how much do you get? You get 365,278. Right? Are we fine? So now, when you add these two, do you have any current asset? No, it's only land and equipment. So when you add these two, you get your non-current asset, right? And then now, I'm gonna just go to your current asset. So this one, it should be utilized less than a year, right? The first one we have what? Inventory. And then you ask yourself, was there any adjustment affecting inventory? No. And then you write it the way it is. 34234. Secondly, you have receivable. Right? So with receivable, what is your balance for receivable? It's 234,342. Right? Okay. And then most of you are also struggling when you get to this part whether you should include your allowances for bad debts, Is it a plus or minus and all that? Okay, let me just show you something. Let me just show you something with receivable. So we have receivable, and then we know that it's a what? Asset, right? And then asset increases where? On the debit, it decreases on the side. And then what was the balance for receivable? 2, 3, 4, 3, 2, 4, 2. Right? Okay. And then now I'm gonna do the account for allowance. Just wanna show you something. Allowance for so remember, allowances for doubtful debt, it's a negative asset, so it means it's going to increase on the credit and then it's going to decrease on the debit, right? So, okay, what was my balance on the trial balance? My balance, it was 50,000, right? And then they told me that I need to have a balance at the end, which is 30,000, right? So basically, I need to decrease this 50,000 to get 30,000. So they're telling me that I must have a balance of 30,000 because they said it should be adjusted to 30,000. So 50 minus 30, I got that I need to decrease my allowances for doubtful debts with 20,000. And then this 20,000, it was your bad debts, right? Do you see what's happening? So now, remember, if this one is your balance, we're going to take it here. And then if I need to close off this account, I'm going to take it off to what? To receivable. As 30,000. So we are closing off this balance to receivable as 30,000. So now, allowances for bad debts is debited with receivable. Nah? So now it means receivable will be credited with allowance for 30,000. So do you see what's happening? Allowance for bad debts was debited with receivable, right? 30,000. So now it means your receivable should be credited with 30,000 for allowance. So now this will take us, okay, let me just fill this. So if you take this 2,343,000, you minus 30,000, you get 13242, right? So now this one, it's your balance that will go to your statement of financial position. So do you see where does your allowance affect your receivable? So if this balance was on this side, so it means your allowance for doubtful debt will be on the debit side. Because remember, where there's a credit, there must be a corresponding debit. So now, where there's a debit, there must be a corresponding credit. So now if you are preparing a statement of financial position, not the ledger account, what are you going to do? You're going to minus 30,000 on the balance. So it's simple. So now, you just say minus 30,000. And then we saw our balance, which is 2,313,242. So are we guys fine? Okay, which account do we have again that affects our current asset? We have bank. Do you have any adjustment affecting our bank? Nope. So we're just gonna write the weight is 265, right? And then do you have any other account that affect our current asset? Okay, look at your VAT control. So your VAT control, it's on the debit side. So if it's on the debit side, it's an asset. If it's on the credit side, it's a liability. So if your VAT control, it's on the debit side, it means our input were greater than our output. So it means this is what we call VAT receivable. So I can bring this question on a multiple choice. I can ask you that if I have a VAT control which is debited, and then I give you option 1. Is my input greater than output, or is my input equals to output, or is my input less than my output? And then you know that here my input are greater than output. Or I can bring this question on the multiple choice, and then I say to you, if I have a debit VAT control account, is it receivable or payable? So the fact that it's an asset, it means it's what? Receivable. So you see, guys, you need to understand the theory behind everything. You need to understand the theory behind everything. And then I can ask you here, what if I have a bank balance on the credit side as 265,015 on the credit side? Remember, on the credit side, not on the debit side. And then I give you options. Is it an asset? Is it equity? Is it liability? And then the fact that it's on the credit side, it's bank overdraft. I have a present obligation to pay back that money, right? And then I say it's what? It's a liability. So you need to play around the theory behind the accounts. So now my VAT control is on the debit side. So if it's on the debit side, it's receivable, it's an asset. 3, 4, 1, 2, 3. Okay, do we have any current asset? Nope. And then we have what you call a total asset. So we are almost done. By 5 past I'll be done. Total asset. Okay, let's calculate that very fast. 343,242 plus 365,278 plus 34234 plus 2313 plus 242 plus 265,015,3412. And then I get my total asset as 3365134. Right? Okay. Quickly, let's do equity and liability very fast, and then we should get to this balance. There's a reason why we call it a balance sheet. It should balance. Equity and liability very fast. So equity and liability, right? So with equity, which equity do we have? We get the trial balance on top. We have capital. So remember, capital is part of equity. Remember, equity, we talk about dice, right? Dice. We talk about dice. So we have capital. There's no adjustment affecting that. So it's 2344004, right? And then we have what you call retained earnings. So there's the profit that we set aside for future purposes. So it was 1,020, right? And then now at the end of our financial period, we made a profit of how much? So you need to add the profit, 6851. If it was a loss, you're gonna subtract it, right? And then you add these two, you get 7871, right? Okay, and then I go to my liabilities. So we have what you call a non-current liability. So it's the same as non-current asset. They should be used more than a year, right? Do you have any non-current liability? No. So we don't have any mortgage loan. We don't have any bond. It's okay. We have nothing. And then lastly, we have current liability. This one should be utilized less than a year. So what do we have here? We have payable, right? Does your payable have any adjustment affecting payable? No. So we write it the way it is, 998259, right? And then do you have any other current liability on the trial balance? No. And then you ask yourself, do I have any current liabilities on my adjustment? Yes. Adjustment number 2. Adjustment number 2, we made income received in advance for 15,000. So remember, I told you that it's a liability. Why is it a liability? We received income in advance Ne? So now that our financial year ends 31st December. So if that person or that tenant decide to leave our premises at 31st December 2018, it means now we need to pay back that person the rent for 3 months, which is 15,000. So we have a present obligation to pay back that money, right? There's an outflow of cash. So that's why it's a current liability. So income received in advance for 15,000. And then total equity and liability. So it should give you that same amount as the total asset. So you take 2,344,004 plus 7,871 plus 998,259 plus 15,000. Then you get 3,365,134. Right? So 3,365,134. So it's balancing. Right? So 3,365,134. And then that's the reason why we call it a balance sheet. Right? So the amounts are the same. Okay, just to add something here. So remember, we can have VAT control here. So VAT control here under current liability, it's when our output, okay, let me write it here. So under current liability, we can have VAT control. Né? So here, it's when our output are greater than input. And then here, it's what we call payable. Why is it payable? It's a liability. What's happening with the liability? It's a present obligation that you should pay SARS that money, right? So remember, I can ask you this on the multiple choice, that if I have a credit, so this one is going to be on the credit side of your trial balance. If I have a credit VAT control, it means that my output are greater than my input. And then it means that I need to pay SARS this money. So it's vice versa of what we had on this question. So I believe that's it from my side. And then we're going to leave this video on our Facebook timeline, and then we're also going to post it on our YouTube. So you can go to our YouTube and subscribe, and then ring the bell so that every time when we post something, you will get a notification. So we're going to post this video also on YouTube.